How do regulators oversee the securitization market? Imagine a busy marketplace filled with complex financial products, where many buyers and sellers are involved. Now picture someone making sure everything stays fair and safe. That's what regulators do in the securitization market. They use a mix of rules, supervision, and enforcement to keep the market transparent and stable. The goal is to prevent risky practices that could cause financial crises and to protect investors and the overall financial system. The process of securitization involves pooling different types of financial assets like mortgages or loans. These pools are then turned into securities that can be traded in financial markets. Because these securities can be complicated and carry varying levels of risk, regulators focus on making sure all the information is clear and accurate. This helps investors make informed choices and reduces chances of fraud or misrepresentation. In the United States, the main regulatory bodies involved are the Securities and Exchange Commission, which makes sure companies disclose important details about the assets backing the securities. Federal banking regulators also play a role, especially since many securitized assets are held by banks. Sometimes the Commodity Futures Trading Commission gets involved if derivatives or other complex instruments are part of the deal. Regulators have learned from past financial problems. After the stock market crash in the 1930s, laws like the Securities Exchange Act of 1930 created the Securities and Exchange Commission to oversee securities markets. Later, reforms like the Glass-Steagall Act tried to separate commercial and investment banking to reduce risks. Although this act was repealed in 1999, the lessons from past crises still influence current rules. The financial crisis in 2008 revealed weaknesses in how securitized products were regulated. As a result, new rules were introduced. For example, the Basel III International Banking Standards requiring banks to hold more capital against risky assets, including those from securitization. This means banks must keep enough money on hand to cover potential losses, making the system safer. One specific tool used by regulators is the supervisory formula approach. This method calculates how much capital a bank needs based on the quality of the assets and how the securitization is structured. Another important rule is risk retention, which requires the issuer of the securities to keep a part of the assets. This aligns their interests with investors and discourages reckless lending. Regulators also demand detailed disclosures about the assets behind the securities. They want to know about the credit quality, performance history, and underlying loans. This transparency helps investors assess the risks involved and supports market discipline. Supervision is ongoing. Regulators regularly review financial institutions' exposure to securitized products, conduct stress tests to see how they would handle economic downturns, and take enforcement actions if misconduct occurs. Over time, the scope of regulation has expanded to include more institutions and activities, reflecting the growing complexity of the market. Looking at the history of financial regulation, we see a pattern of reacting to crises with new rules. Each major disruption has led to tighter oversight, aiming to prevent similar problems from happening again. Today, oversight of the securitization market balances encouraging innovation with making sure risks are managed carefully.